Hello again from Core Wealth. This is the monthly wrap-up for the month of September 2020. So the third quarter is over. We are into the fourth quarter of 2020. You'll see in the background there'll be some movement as the staff walk around, and that is because we are back at the office. So it's good to be back as a team together in one place, still with all the safety protocols, sanitizing and social distancing and recording of temperatures, etc. But good to be back at the office. Let's get into what we're going to discuss today. So if we talk about the economies around the world, we can't not talk about Corona. And what we've seen during especially September, there was further market volatility as the numbers started showing that there was second waves that were appearing in some countries, particularly in Europe. These waves have actually seen higher levels of infection than what we saw in the first wave, but what's markedly different in the second wave is that the mortality levels, or the number of people who are dying, who get infected and then die, is much lower than what we saw in the first wave. For example, in Italy, the number of deaths is less than 5% of what it was during the first infection. And this should point to the economic impact of the second wave being a lot less because of the mortality risk being a lot lower. If we have a look at interest rates around the world, the Federal Reserve in the US has made it quite clear that they are going to keep their interest rates very low to try and support the economy. And this should be good for their economy, but it is expected to see the US dollar as a currency weaken over the coming years. If we just have a look at the South African situation, our interest rates are also at virtually all-time lows, and we expect them to stay at these levels. Some economists are still predicting we could see some further cuts in our interest rate before the end of the year, and inflation seems to be supporting that. Inflation came in slightly lower than what people were expecting, and over the last year has only been at 3.1%, which is a positive in terms of investors' purchasing power. In other words, their prices aren't going up as much as they have in previous years. We've started to see the National Prosecuting Authority making arrests and laying charges against a number of people who have been found to have been involved in corruption, which is a good sign, and hopefully we'll see a lot more of that in the coming months and years. The other bit of good news, just showing that there's a different way of governance that seems to be happening, is you may have seen in the headlines the ANC, some of the political members hitching a ride with the South African Air Force to Zimbabwe, and that was exposed, and the ANC has actually footed the bill and is having to pay for their members who were on that South African Air Force, and just demonstrating that there must be a split between the political parties and government and how government is run. So if we have a look at the markets for the month of September, it was a down month, particularly for growth assets, so property and shares were down for the month, and the worst place to have been was actually in international shares, and particularly developed markets, which were down nearly 5% for the month. Emerging market equities were down just over 3%, and the South African market was down just over 1.5% for the month. Listed property in South Africa had another negative month, as there's still a lot of uncertainty around where property is going to end up, and was down 3% for the month. Bond market was flat, and cash gave you a small return because interest rates are really low at the moment. If we have a look over the last year, things have improved somewhat, and most asset classes, in fact all asset classes other than listed property, are actually positive over the last year, which is some solace given how negatively all markets looked at the end of the first quarter. So we've seen quite a reasonable turnaround since then. If we have a look over longer periods of time, the 3 to 5 year numbers on growth assets, particularly South African shares, are still very anemic. But we'll talk a little bit later on about how we expect things to progress into the future and what opportunities exist there. So if we have a look at our portfolios over the last month, any of the longer term focused portfolios that had growth asset exposure were down, although only slightly, because of equity markets being negative, property markets being negative, and global markets being negative. If we look over the last quarter, the portfolios actually did quite well as a whole, and we actually picked up some outperformance versus history. Over the last year, we've seen some underperformance by some of the more value-focused managers like PSG and Alan Gray, and we've seen some of that being clawed back over the last quarter. If we have a look at our longer-term track record, things still looking good in the sense that we are generating outperformance of our peers, but the absolute returns are not high because growth markets have been so weak over the last 5 or 6 years. If I had to look at two of the funds that have done particularly well, our income fund continues to generate outperformance of money markets in particular, and over the medium to longer term of its peer group as well. And then our flexible fund, which is our most aggressive local fund, has done very well, continues to outperform the equity market, even though it's not a 100% equity portfolio. And then if we have a look at our global portfolios, we're seeing continued good performance from those relative to their global peers, so not South African peers, but global managers, and that's quite exciting to see. So what does the future look like? What possible returns can we be expecting from portfolios? 2 bits of research just quickly. One is we're looking at business confidence in South Africa historically, going back into the 1990s, and looking at the returns that were then generated subsequent to significant low points in business confidence. We at the moment are at an all-time low in terms of business confidence, and what could we expect going forward? And looking at these indicators historically, at these low points, if one looks ahead for the following 3 years, you can see that there's some significant outperformance, as what markets tend to do is over-exaggerate, both on the downside and on the upside. And so markets at the moment, we think, are being too negative on a number of shares, and so those shares should not be ignored, and that we're getting that kind of exposure from some of the value managers in our portfolio. On the listed property side, Sesfikile Capital has done some research into what returns they expect to generate from the listed property market in South Africa, and over 1, 3, 5 and 10-year periods, and just seeing there that over the next 5 years they're predicting almost 23% return from the listed property market. Now that is significant if you think inflation is probably over that period expected to be somewhere around 4%. To get that kind of return is something that one cannot ignore. And so in our portfolios, we're not just loading up on property or loading up on South Africa facing companies. We've got a diversified portfolio, but we will include listed property in our portfolios. We will include managers who have got a focus on some of the South African markets, just because there's attractive valuations there, and as long as you're picking good companies that will survive the tough times, you'll be rewarded for that in the long run. So markets will continue to be volatile, and in the next month even there's some big events happening. Globally, we've got the US elections happening, which creates a lot of volatility. We've still got the news around corona and second waves and things like that. In South Africa, we've got the medium-term budget speech happening in this month. All these things can influence markets in the short term. However, with a diversified portfolio, with exposure to good managers who are able to generate performance over the longer term, your wealth will continue to grow through time. We've had a period of quite anemic growth over the last 5 years, as I said earlier, but we're expecting to see that improve as economies have to kickstart after the corona pandemic, and as businesses look to grow their footprint and increase their profits. If you've got questions, please get hold of your financial advisor. If you want to come and see us, you're welcome to. You'll have to have your temperature taken and sanitize your hands, etc. But it would be nice to see you face to face. Thanks again for watching. Bye-bye. you.